Welcome to episode number 40 of The Rent Roll, your podcast on all things rental housing, apartments, single-family rentals, and build-to-rent. Today, we're talking Contrarian Apartment Investing 101. And to teach us, we have one of the absolute gurus of contrarian apartment investing, David Schwartz, the co-founder, CEO, and chairman of Waterton, based in Chicago with more than 30,000 units and ranking in the NMHC top 50 owners. He's been doing it for 35 plus years, and he's learned alongside some absolute gurus and legends of the industry, some titans like Sam Zell of Equity Residential, Greg Mutz of AMLI, Barry Sternlicht of Starwood, and of course, Bob Faith, who went on to start a little company you may have heard of called Greystar. So we'll hear some of David's story today, and it's a remarkable one. And it really starts and continues and still today is all about contrarian investing. And so we'll talk a lot about that. And he's going to give us a good history lesson that reminds us that contrarian investing is not about just betting on one market or one strategy for years and years and decades throughout cycles. It really means, I think what you really learn from him is that it means following the opportunity. And he hasn't locked in. The strategy's changed over the years. Strategy evolves as opportunity evolves. So back in the 1990s, the entire apartment sector, and really late 80s when he started his career, throughout the 90s as well, apartments were not a very popular asset class. They were very much an alternative asset class. The entire apartment sector was viewed as contrarian. Institutions hated apartments. They viewed short-term leases as a negative, and they viewed the complex rent rolls. I mean, having 100, 200, 300, 400 plus individual leases was viewed as a red flag, a negative, not the positive that it is today. Today, the complexity of rent roll and the short-term nature of leases, being able to turn and reset to market rates, like that's viewed totally opposite of back then. It's now viewed as positives. And so as a result, we've seen apartments become a much more favored asset class, obviously. Back then when David started his career, office was king. And then back then, again, office was king. Apartments, they may have been like the court jester. It was somewhat viewed as a joke, but obviously that changed in the late 1990s and 2000s. We entered the peak REIT era, and that brought more capital into the space than the GFC hit. Back then, there was a lot of talk about flight to quality. Capital was chasing the big coastal cities with high barriers to entry, and the economies were being viewed back then as more resilient as well. But then some groups went heavily into contrarian investing by betting heavily on the Sun Belt, which was booming like crazy, but was still perceived by much of Wall Street to be the backwoods for poor hillbillies and pickup trucks. So that too, of course, started to change in the latter half of the 2010s decade, even prior to COVID, as the Sun Belt outperformed with demand outpacing supply in many of these markets, not all of them, but many of them. And then, of course, really accelerated through and after the COVID period. And throughout this last cycle, up until the last year and a half or so, as supply ramped up, the Sun Belt and mountain markets really were king. Coastal cities were suddenly viewed as heavy risk, and I've talked about that a lot on this podcast, due to the rapidly intensifying regulatory headwinds in major coastal cities, rent control, eviction moratoria, screening limitations, transfer taxes, and then, of course, just generally being labeled as the bad guy, no matter how much you want to be part of the solution. So now, of course, that means everything is flipped back, where it's contrarian to bet on certain coastal cities again. And I've made this point before, but in some cases, we'll talk about Los Angeles today. This is a market, it's the second biggest city in the U.S., a core city, but it's no longer a core investment. So enter guys like David Schwartz, who's been a successful investor in the Sun Belt and the Midwest. And he's been in the coast over the years as well, but now he's making moves back into some of these coastal cities like Los Angeles and San Francisco and some others, because he now sees opportunities there with pricing becoming more favorable again. And so we'll talk a little bit about We'll talk with David about his track record with contrarian investing, what he sees in these high regulatory risk markets, how he thinks about regulatory risk and underwriting. How do you account for that? It's always something I like to ask people who are betting on these markets. Just how do you account for it in an underwrite? And then, of course, we'll also ask David about how he sees the difference between a smart contrarian strategy. Or I should say, maybe rephrase this. What's the difference between a smart contrarian strategy and just a wild bet? Because the two are not the same, right? And so I'm going to ask David about how he sees the difference and what's helped him be successful with that over time. So it's going to be a fun conversation. Stick with us for that. Before we dive in, big thanks to our sponsors. First, to JPI, a leading apartment developer with a stated purpose to transform building, enhance communities, and improve lives. And also, thank you to Waymaker, a multifamily investment group focused on Class A market rate apartments, including new construction and attainable housing, partnering with best-in-class builders across the Texas and the Southeast. Okay, so we kick it off with here's a chart. And we're focused today on the theme of contrarian investing. And I think, there's a lot of things we could define as contrarian, but I think from where we are sitting at this moment, and these are things I've talked about a lot in this podcast and in some of my writings. Yeah, I think there's two major categories of investment I would call contrarian or out of favor. And of course, these are somewhat subjective terms. You could define them how you want. I'm just going to give you two I think are pretty mainstream right now. One, I alluded to earlier, coastal core cities with high regulatory risk. We'll spend a lot of time talking about that a little bit today. The second one is older vintage, value add, CapEx intensive projects in the Sun Belt. And by that, I mean, I've talked about this previously, where you had a lot of capital maybe in the previous cycle that bought, apartments that are built in the 70s and 80s, not in the best submarkets, need a lot of CapEx to maintain those properties, maybe have some rent roll risk as well. And those have been some of the most challenged properties that we've seen as rates went up. So those are two categories I think that are very, very different, but we could probably classify as contrarian. So we'll talk a little about the coastal cities, since that's what David's strategy is focused on, but I'll touch on the other one as well. So let's start by looking at these coastal markets. In this first chart, it shows you markets of increasing or decreasing appeal for apartment capital, if those of you can see this chart. And I've showed this one before, so I just want to briefly recap this. What I've done here is it looks at what share of total apartment sales went to each market in the 2010s versus the 2020s. So it adjusts for market cycles and, up and down movement and just total flow. But what it shows you is New York has seen significantly smaller share of total U.S. apartment sales in this decade than it did previously. That's down more than 500 bips. Washington, D.C. and Los Angeles, both down almost 200 bips in terms of market share. Also substantially down in San Francisco, almost 1% in San Francisco, Seattle, and Chicago. So these are markets that just aren't as in favor in this decade as they were previously. And in most cases, obviously you have some of like a downtown San Francisco story where you had just a kind of challenging demand environment for a period of time. But for most, and most of these, it's really more about the heightened regulatory risk associated with some of these long-term eviction moratoria after COVID, heightened rent control risk and other factors at play. So let's zoom in on Los Angeles a little bit. And this is another chart I've shared previously, but I want to show it as a kind of illustration. This drills into LA versus other parts of Southern California. And what it shows you is, again, that same measure, the total, the share of each market's, each market share of total apartment sales. So you can see this big drop off in Los Angeles, but I like to show here it's not just like a whole California issue. It's not even a Southern California issue. We can see a big drop off in the share of sales going to LA, but it's been a pretty steady story in Orange County, in San Diego, and in Riverside. And so again, it really is unique to LA, and specifically the city of LA, where we had the one of the longest eviction moratoria in the country, which essentially made rent payment optional for a long period of time. And of course, we also had the ULA transfer tax, which adds about 5.5% tax on all apartment or most apartment sales over a certain size, a little bit smaller for non-institutional small apartment buildings, but generally a 5.5% tax regardless of when it was built or the affordability level, et cetera. And that's backfired, fewer apartment sales and reduced tax revenue, ironically, as well. So, and those are just a couple of the challenges we've seen there, as well as just the general hostilities to property owners. And then we also see it in terms of construction. And so, historically, one of the drivers to these coastal markets was lesser supply and higher regulatory risk. What's happened now is it's the same factors that make it hard to build in these markets now make it hard to operate, which make it even harder to build. Because even if you have development capital, the people who come in behind that have to believe they can not just build it, but actually operate it. And that's become less clear. And so the share of all U.S. apartment starts in the LA metro area has decreased as well. It was averaging, let's call it 3.5% prior to COVID of all apartment starts in the U.S. Now it's been around 1.5%. So it's about half of what it was, even through this big jump in apartment starts nationally. So again, that's kind of setting the stage for our conversation with David. These are still core cities, and I'm not one that says, hey, everyone's leaving Los Angeles, everyone's leaving San Francisco, everyone's leaving New York. These are markets that I think are a little bit misunderstood. What's really happened in a lot of these cases is that, yes, there is out migration from places like Southern California into the Sun Belt, but there's still a structural shortage of housing. Okay, and especially for the middle and upper income households that rent in institutional grade apartments in these regions, there's not a demand side issue. There's still a structural shortage of housing, and you still have the vast majority of the housing stock that was built decades ago. And so I think you could still argue there's a shortage of good quality, kind of Class A housing in these spots. So I'm not a demand side doomer. I think the real risk and the reason for less capital interest in these markets is really more to do with regulatory risk. It's something that even the publicly traded REITs have talked about quite a bit on their earnings calls as well. And then real quickly, I just want to touch on, the Sun Belt. I think one thing that's really changed is during the last cycle, we saw so much interest in the value add strategy, the fix it and flip it. And for a period, it really worked so well. We had so much capital coming in, do some renovations, and then full or partial, and then sell it oftentimes pretty quickly for a pretty good premium. And again, that worked until it didn't. A higher rate environment makes that more challenging. Another factor we've seen is that in some of these you have, I've talked a lot about affordability, generally more of a tailwind than a headwind. But when you do have older Class C apartments, this is where we tend to see people spending a higher share of income on rent because their incomes are much lower. And in some of these cases, they've lost their higher income renters to Class B and Class A properties because of the filtering effect of new supply. And that's left those who are there are those generally the folks who can't afford to move up. And maybe these Class C properties are even cutting rents in order to pull in people who previously couldn't afford market rate at all. So you do have affordability challenges. So just turning over the rent roll isn't that easy, or just doing a renovation, keeping your rent roll isn't that easy. And then turning, of course, can be dependent on the location you have as well. Other challenge here is just, I think you're going to see a widening of cap rates. We're already seeing this a little bit. I'm not sure we're there yet in terms of the finality of it between the Class A and Class C market. That really, we saw so much cap rate compression between asset classes in the last cycle. Those have to kind of widen back out again, have to normalize, I think. And so we'll see how that plays out, but that could impact the values. And that's a part of the market. Sometimes you hear people say, oh, the Sun Belt's in trouble or distressed or whatever, people who don't really know what's going on. It's a bifurcated story. And there's still a ton of capital that's chasing, generally your, Class A, B plus apartments in good submarkets. But, there's a whole different market when you get into, the B minus and Class C market, especially in less desirable submarkets. And these older apartments that are 30, 40 plus years old, they're just getting older each day, which means, more CapEx needs as well. So that's a tough market. Eventually, I think someone's going to do well with it, but it's not as clear as I think the Class A market and Class B plus market in some of those spots. So how that plays out, I think is going to be really interesting. That's certainly a different contrarian bet that we don't see many institutions willing to take right now. All right, let's move on to rental housing trivia. Today's rental housing trivia is brought to you by Foxen, a technology-first renters insurance compliance and rent reporting platform that helps you reduce risk and drive NOI. Check them out at foxen.com. And for those of you who are listening on release day of this podcast, we do have a webinar with Foxen that I'll be participating on today. And I think you'll be able to watch it later on as well, possibly. But you could find that at foxen.com, Foxen. And we'll be talking about kind of where the market is right now, revenues not growing as fast as rents, and some strategies to improve NOI. So check that out if of interest. So today's trivia question is, what was the name of the government agency created in 1989 to manage and ultimately sell off distressed real estate assets, including a lot of apartments, following the savings and loan crisis? Okay, so I'm going to talk to David about this in a little bit, but some of the first modern contrarian apartment investing occurred in the early 90s amidst the S&L crisis, following the creation of this government agency. And it ultimately auctioned off a ton of apartments, contributed to the formation of some of the early apartment REITs as well. So it essentially was a government, well, essentially it really was a government-owned asset manager charged with liquidating assets from more than 700 different S&Ls or thrifts. So what was the name of that agency? And I'll tell you, it's no longer around, but it was a massive part of the real estate business in the from about 1989 to, I believe, 1995. So give that some thought. We'll answer that in a bit. But next, in the news. All right, the biggest news in multifamily this week comes from Twitter/X, and specifically the account of the Buffalo Bills NFL football team. They gave a big shout out to one of their season ticket holders, Matt Ferrari, who many of you know is also an executive at True America Multifamily. So Matt is an avid climber and just recently reached the summit of Mount Everest. And he brought with him flags representing True America and also his beloved Buffalo Bills. So big congrats to my friend Matt. And we need to get him on the podcast at some point to talk multifamily and Mount Everest. Next headline comes from the Wall Street Journal. New York's housing crisis is so bad that a socialist might become mayor. And then it talks about this candidate's pledging to freeze rents and how he's jumped ahead in the polls. So let me read a couple snippets from this. New York City renters face hyper-competitive market, record low vacancies and surging rents. And then the campaign to freeze rents, specifically for rent stabilized housing or rent controlled housing. And then it also mentions the FAIR Act, which banned broker fees and resulted in spiked rents, intensifying the crisis and pushing renters to spend more on housing. And that's really what I want to focus on is as we think about a potential impact of a rent freeze, which is obviously pretty obvious. And the rent stabilized part of New York has already been hit hard by the 2019 law that legalized vacancy control. I've talked about this previously in this podcast. We now have vacant units that, if owners just can't afford to renovate them because they can't get the rent to justify or to offset the cost of the renovation. But now we have yet another example of the law of unintended consequences at play. And this one's related to this broker fee ban that I mentioned earlier. Let me read a little bit of this. It says, the FAIR Act went into effect on June 11, banning the longstanding practice of brokers charging tenants fees. Rents rose overnight and have continued to climb. Just over a week since the enactment of the FAIR Act, rents are up an additional 16%, according to early data from the real estate analytics firm Urban Digs. The median asking rent spiked to $6,346 on Sunday, raising the rolling average to $5,599 for the past week. All right, so a 16% increase. Now the cynics will say this doesn't really change the net effective rent once you factor in the broker fee, that it's just amortizing the broker fee over the duration of the lease. And that's true, but think about what that means. One thing that people aren't mentioning is that a higher base rent sticks into renewals, whereas a broker fee is a one-time fee paid up front. So if you renew your lease, you're going to end up paying more, or likely end up paying more over the long term if the broker fee cost is pushed into the base rent. Now, I want to be very clear on this. I am not a big fan of New York City's antiquated broker leasing model. We don't really see anywhere near the same reliance on leasing brokers in most other U.S. cities. But it's just another reminder that New York City is just a completely different market from the rest of the U.S. for the most part. But I'm just pointing out the short-sightedness of the law and how it follows a similar pattern of policymakers rushing into populist ideas on housing without thinking through the inevitable side effects. The same as the ULA tax in LA, the rent control in St. Paul, which killed the supply pipeline. It's just yet another cautionary tale. And so I tell you, for most of the country, they didn't have to ban broker fees because when you have enough housing, then there's no need for broker fees. And also you have apartments that are able to invest into modern technologies like property websites and online leasing. And, those are things that we don't see as commonplace in New York. And so it's a different market. And, but ultimately, no one likes to pay fees, and rolling it in is probably more convenient, but it certainly doesn't make things cheaper. All right, and our next headline comes from the U.S. Census. It's the monthly new residential construction data release. Not a big change in the storyline. It's just a continuation of it. Starts continue to come down. Also, completions continue to outpace starts. In the last 12 months, we completed 228,000 more units actually almost 223,000 more units than we started over the last 12 months. And then ongoing construction, according to the census, dropped to the lowest level since 2021. The private data sources showing it has dropped off even more than that. And so I think those numbers will come down even more. And of course, for developers, it's a tough market, but it further just supports the case to get new projects started now, because with this drop off in starts, it's going to be completing in a period of the next couple of years when there'll almost certainly be very limited supply on the market. Let's come back to our rental housing trivia question of the week. It was, what was the name of the government agency created in 1989 to manage and ultimately sell off distressed real estate assets, including apartments, following the savings and loan crisis? And the answer is the Resolution Trust Corporation, aka the RTC, which was in existence from 1989 to 1995. And if you're like me and you weren't in the business back then, again, you may hear folks call it the RTC era, but we'll hear from David Schwartz in a bit, talking about how that period was impactful for him and for the industry at large. So that's a good transition point into today's interview. I'm thrilled to welcome in Mr. David Schwartz, the co-founder, CEO, and chairman of Waterton, also the past chair of the National Multifamily Housing Council. And in that role, he was on the Hill in Congress, testifying on issues like the eviction moratoria, representing apartment owners across the country. Waterton is based in Chicago. They rank in the NMHC top 50 owners with 30,000 plus units. So let's welcome in Mr. David Schwartz. All right, now we enter the interview portion of today's podcast, and I am very honored and thrilled to welcome in David Schwartz, the founder and CEO of Waterton. So, David, thank you so much for being here.
Well, thanks for having me, Jay.
So before we get into it, obviously a lot of people in this industry, everybody knows you, they know the Waterton name, but tell us a little bit of your background story about just going back in time a little bit, how you got into the multifamily business.
Well, I'll try to do it quickly because that could take an hour. So I started in the business in '86 at a startup shop called AMLI. And I was actually a tenant rep there on their office building side of their business. But my workstation was across from Pete Villam's office. Pete Villam is my partner in Waterton. We co-founded Waterton. And I ended up working for Pete. Pete was responsible back then, and this is, call it 1987, for their fledgling acquisition business. They had a separate account with the Unisys Pension Trust, and they called it the AMLI Southwest ventures, and it was to find mispriced multifamily in the Sun Belt, mainly in Texas and but some other markets like Atlanta. And Pete needed someone to help him do that, and he didn't like traveling that much. And I'm like, well, I'll do that for you, and that's how we got started. And we were buying, back then, everything was pretty stressed. It was the end of the 1986 Tax Act, which that Tax Act, before that, there were enormous tax benefits for building multifamily, like 3 to 5 times uh, deductions, losses generated by accelerated depreciation. So the market was really overbuilt, and the Tax Act just shut that down. And so there was a lot of stress. And we were buying in Dallas and Austin for, $25,000 a unit. And that was really how I started learning in the business. And then I went on. I got my MBA at night, which Greg Mutz was kind enough to give me a loan to get my MBA, and I had to pay him back every penny. And when I graduated in 1990, I just started looking around just for grins, and there was a great opportunity at this company called Equity Group Investments, and they had a new opportunity fund called the Zell Merrill Lynch Fund. And so I ended up doing multifamily acquisitions for the Zell Merrill Lynch Fund,
Wow.
and that was in 1990, and then we went public in 1993, created Equity Residential, and I ended up for running acquisitions, working for Doug Crocker, and then got the band back together with Pete Willem in 1995 to start Waterton.
Yeah, so I want to get to that on the Waterton start in a minute here. But first of all, I mean, what a heck of a job you did picking winners between a little startup called AMLI that obviously is a big name now, Equity Residential. So you alluded to this, but I'm really curious. Those of us who weren't in the industry in the 80s and early 90s, we hear about the S&L crisis, the RTC era, the Tax Reform Act of '86. But what were those years like, especially as someone new to the industry, and what inspired you to stick with it through all that chaos?
Yeah, well, it's interesting because today we're kind of in a long cycle that people are really complaining about. And when you go back to like 1987, that was well before the RTC. So there was already like a real commercial real estate crisis, and it took a long time to get through that crisis. The RTC era really didn't start till the early 90s, like 91, right. 92. That was under Bush 41, who created the Resolution Trust Corporation. But there were all sorts of bank reorganizations going on before that. There was FISLIC and FDIC liquidations, and so there was just a lot of stress and very little equity capital out there, and that was one of the reasons going to equity was so attractive, because the Zell Merrill Lynch Fund, which was called 1990, was one of the first real estate opportunity funds. I think it was before Blackstone raised their first opportunity fund. And so that was an amazing opportunity for me to take a job working there and be part of that. And all the stuff we bought in 1990, 91, 92, we were way too early. So it took a long time for the market to correct. And there were, the RTC, once that kicked in, that was a whole different ballgame. That was auctions of large pools of assets. Everything else was rifle shooting, one-off distress deals, dealing with a lender or the FDIC or FISLIC or whoever it was. when the RTC started, they were in this big time. They were moving the merchandise, and that was really what created the big players. That Starwood had started in the early '90s. There was companies like J.E. Roberts, Blackstone. I think they began their first op fund because there were these huge auctions, and at Zelmer, doing acquisition for Zell Merrill Lynch, we actually didn't win one RTC auction.
Wow.
It was too hard for us. They were, um, you know, huge number of assets. You had to make a bid. You really didn't get a lot of due diligence, and if you won, you were bound by that bid, and so we weren't really set up for that. So we ended up buying a lot of assets from the wholesalers who bought out of the RTC, and then we pick off the assets we liked. And when we went public with EQR, uh, we took Sam's legacy portfolio of assets, and it wasn't big enough to go public. It might have been 7,000-8,000 units. I can't remember how many units it was. And so we ended up marrying up with Starwood, with Barry Sternlicht and Bob Faith, and combining all these assets they had either bought through the RTC or had tied up that were under contract, and contribute them into the IPO. And so at least half the units were not even units that were part of the original legacy portfolio. And that was Starwood's first realization, was the IPO of Equity Residential.
Wow. Must have been incredible as someone relatively early in your career, and you're working with the names like Sam Zell, Barry Sternlicht, Bob Faith, on down the line, and you mentioned Greg Mutz. I mean, these are all titans in the industry.
Yeah, they still are.
Yeah,
and Sam obviously passed a couple of years ago, but was Sam and Greg had Greg's still a mentor to this day. Still talk to him routinely, and Sam was a mentor till he passed.
So let's fast forward back to 1995. You started Waterton with Pete. You've just left. I believe AMLI was publicly traded, right? And at the time, and then EQR. So what was the initial strategy that led you to start Waterton?
I don't think AMLI was public till like 1997. So a few years after we started Waterton, but so one of the things that I saw now, because we were entering what we call the modern REIT era, was there was this great opportunity to be like, these young upstarts like Barry Sternlicht, Bob Faith, and there were others, like just crafty people buying multifamily, at very low prices. And what I saw them doing is they would buy them, they would paint them, they would seal coat the parking lots, they'd fill them up, and they'd turn around and sell them for a really nice profit. So it was a wholesale to retail strategy. And the reason I knew that is because I was at Equity Residential, and I was the guy in the front line buying those wholesale to retail conversions, and I'm like, I want to be the wholesaler, and so really the business premise of Waterton and what I pitched to Pete was, we need to do that. We're smart enough to find those properties and essentially put lipstick on the pig, paint them, seal coat, fix them up, fill them up, and we'll sell them, and the exit will be the REITs, because there were many public multifamily companies that had just IPO'd in that era. So that was going to be our retail exit. We were going to be the wholesalers. Today everyone would call that value add multifamily investing, but there weren't really many players back then. It was a pretty limited universe of groups who could do that, who had the energy and wherewithal and desire to do that. And multi still at that time was kind of an out of favor asset class. I mean, it was not considered that institutional. Anything with a bed back then really was not considered institutional real estate. Office, suburban office, malls, all the things that are so out of favor today were considered institutional bread and butter, but multi really was not like that back then. And so that was the opportunities create, kind of institutionally acceptable multifamily, and sell it to the REITs or whoever else would buy that back then.
Yeah, it's funny because you mentioned that it wasn't institutional, and that probably started more in the 2010s decade, I guess, after the GFC. But looking back, like what did institutions not understand about multifamily? What did they miss? Was it the complexity of a rent roll, the lack of transparency in the data being more real time now than then? I mean, what did they miss?
I think it was pretty simple. They didn't think these were credit tenants. They were buying credit. And they were short-term leases.
Yeah.
So that was like the opposite of what they wanted. They wanted named credit, or at least perceived credit, good business behind the lease and term. And that there was none of that in multi. But what they were learned is multi has the ultimate inflation hedge because the leases adjust on average every year, and that the tenant credit is actually pretty good.
Especially
I
for
think
A and B apartments.
And so you saw as you advance into the 90s and early 2000s, more and more pensions through advisors were finding multi to be more acceptable.
Mm-hmm.
And multi also traded at higher cap rates than other asset classes. So you got this yield premium that you could take a high quality multi and probably buy at a higher cap rate than a moderate quality suburban office building. So
Yeah.
there was like an arbitrage that institutions like, oh, that's not too bad. And then on top of that, the agencies were offering relatively affordable financing. And so I think that was catching on. You saw more and more institutions. And we saw that at AMLI, because I worked there, they were one of the early, institutional pension advisors working with different pension funds. And you saw Reef and Heitman and others start to acquire multi on behalf of their pension clients.
Interesting. So let's fast forward to today as we talk about kind of modern Waterton. What does today's portfolio look like in terms of size and markets and asset types within multifamily?
Yeah. So assets under management are about $10.5 billion. We're somewhere in the 33,000 unit range. We're in about 20 of the top markets in the country. Maybe 25 to 30% of it's urban, and the balance is suburban. And so you have a wide variety of garden style multifamily to high rise in the more urban areas, and wrap and podium style in different urban suburban areas.
So, going back to the early days of your career, you've been very successful pursuing contrarian investments. In fact, you're talking about like Texas, and it's funny to me because you'll talk about overbuilt Texas, and overbuilt Texas was probably really 1980s, right? I mean, there was a lot of that. And so, as you look back over your career and even to today, like, what do you think makes a good contrarian investment versus just a wild bet? Like, what's the difference? What do you look for?
Yeah. Well, look, contrarian has different meanings, or sometimes they're out of favor as a term, but really ultimately it's about pricing, um, and the ability to have less competition when you're buying, and in a market that has good supply demand characteristics, or at least near term to long term good supply demand characteristics. And so, in certain moments in time, you can find out of favor markets that happen to have good supply demand. Maybe they have other issues too that is causing capital to leave that market, and so we've historically take advantage of opportunities like that, where there's a capital void and a fundamentally decent market for some reason, and so I could go back. I mean, certainly in the late '80s, early '90s, uh, that was all the Texas markets. The whole Sun Belt was distressed and out of favor, in the last place institutional capital would be interested in. But there were terrific buys, and throughout Waterton's history, we just gravitate to those types of markets. In '01, we one is Seattle was a market that became way out of favor after 9/11. Boeing, went through another round of layoffs. We see that in different cycles, and Seattle was very Boeing dependent, and we bought 3 or 4 deals in Seattle in kind of '01, '02. The That was also the tech wreck at that time. The Y2K, and all the .com companies blowing up, and we found great opportunity in some of the tech markets, like in Austin and the Bay Area. So that was in '01, and during the GFC, there were markets like Vegas, Sunbelt markets like Phoenix, particularly markets hit the hardest by the home building industry, where there were amazing buys. And today, the modern version of this are, and I laugh at it because today the modern version of this are the gateway markets, which 5-6 years ago, these markets were called the sexy six. They were the most desirable by the most institutional investors. That would be San Francisco or LA or Seattle, or even Portland might have been, maybe it would have been in the sexy seven. Washington, D.C., New York. So a lot of those markets are out of favor. You could call them contrarian. And so there has been a good opportunity. Chicago has been out of favor, and we started investing again in Chicago 2 years ago, and found amazing buys that are in the money. They were very high cap rates, and cap rates are still high in Chicago. So, but we still appreciated on that vintage of assets. So, there's good opportunities in those. And Jay, the funny thing is, the contrarian markets are pretty soon, or we're already seeing, are what have most recently been favored markets, like Austin. Austin, is very overbuilt. Nashville, urban Nashville, will become an out of favor, more contrarian market because the supply is so significant. So you just kind of see that move across the country, and it's always good timing to invest, as those markets become out of favor and there's not a lot of competition to buy assets.
Absolutely. And I love the cyclicality of real estate because, as you mentioned, it just moves around a little bit. And you call that the sexy six. And in my sense is, I think that, the sexy six, like San Francisco and LA, seem to still be viewed less favorably than some of those other spots. And most of those challenges aren't necessarily demand side. It's more policy, long-term eviction moratoria, the ULA transfer tax in LA. And so I want to talk about, you've been active in LA. So you've talked about this a little bit already, but just more specifically, like what drew you to LA and specifically to downtown Los Angeles?
Yeah. Well, we bought one property downtown in December. So one great thing with our flagship fund, it's a large format vehicle, so we can diversify and take risk and where we think there's good opportunity. And downtown LA, I don't know how much more we're going to buy there, but we took the approach. One, you can the discount to previous peak pricing, say call 2021 pricing, is 40%. I mean, it's enormous. There's a large cap rate premium. And the one asset we bought there is, kind of in the LA Live area. So we think it's somewhat insulated from some of the issues in other parts of downtown LA. And, for us, it was important to have, a high enough cap rate to compensate for some of the uncertainties there. And we're making the bet that, with the Olympics and World Cup and some other, hopefully, political change, that things were off the bottom and kind of on a upward trajectory, although slow upward trajectory. And so we can afford to make a small percentage of our total fund in an asset like that. And that's what we did there. And, the fundamentals are fine. You have relatively full occupancy. You're done with concessions. There's positive trade out rents, positive renewal rents. So, now your risk is there going to be like even more ULTA transfer tax on top of the almost 6%? We think very little chance. In fact, we think there's more chance that'll get reversed or some portion of it, because it's actually been a revenue, it's impaired revenue, transfer tax revenues. And so we don't think there's further risk of that. Is there further risk of more moratoriums? Yes. I mean, they just implemented one for the fires, so, which we're almost done with. But, we think you can get that in other parts of the state. The biggest risk is statewide. And that could happen in Orange County or San Diego, is what we just went through with Prop 33, Prop 34. And, we have successfully fought these statewide rent control referendums over 3 election cycles. I think this last cycle, we hopefully have put it to bed to some extent, but you still have that risk statewide. So, we're taking a measured approach in the LA area. We're certainly committed to, top suburban parts of LA that we're actively looking at. So that'll continue. San Francisco is another place we've made investments recently. And again, other different kinds of risks. But that's an example of a city that political change has taken hold for the better. They have had a successful new mayor who's in place, who in a short period of time has done amazing things with cleaning up homelessness. Tent counts and other metrics are way down. You're seeing back to work in the tech industry, really supportive of the resurgence of that city. So we feel very positive about it. We're very happy with. We did a large transaction there in the SoMa market. We're looking at other things in the greater Bay Area. We have significant interest. So I think the overall Bay Area, including South Bay, has the highest trade out rents in the country right now.
Yeah.
And
Especially
that's
Silicon
really
Valley.
Silicon Valley and the tech industry and AI, are coming back, and you're seeing some companies that had moved to like Austin are now coming back because of the talent there. So we're positive about that, and
Mm-hmm.
so again, in '01, the Bay Area was written off for dead, for absolute dead, and that was an incredible comeback, and then it got written off again. So I wouldn't bet against it on the long term, and but it did get pretty ugly, coming out of the pandemic. It was a tough spot and hard to have courage to make investments there.
Sure. So I love these stories about LA and San Francisco because it reminds me, it's like you described, like these were core 1A markets previously. Now these are opportunistic investments. And so
Yeah.
how much of a discount, or you mentioned like higher cap rate, like how much of a discount do you need for these deals to work, given the challenges that you're coming into?
Well, the one thing is you have enormous replacement costs in both of those markets. They're higher than other parts of the country. So you're going to get probably the largest discount to replacement cost in LA and San Francisco when you look across the country. But you're also getting a cap rate premium. I think, I'm going to throw out some loose premiums, but I would say in LA, you're probably 100 basis points above, a good Sunbelt market. And keep in mind, the Sunbelt market is going to have softness. You're not going to have as much rent growth as LA or in the Bay Area. You're not going to get quite as big a cap rate premium. It's always been a lower cap rate market, but your cap rate premiums are probably, still higher than some of the Sunbelt markets. If a good high quality Sunbelt deal trades in the high fours on a cap rate, you might get 25 plus basis points premium in the Bay Area. So that's unheard of. The Bay Area always had significantly lower cap rates than any Sunbelt market.
Yeah, absolutely.
It's a little bit the opposite today.
Absolutely. And so a related question, when you think about a contrarian investment like these, does the exit timing, is that strategy change? Does it require a longer term view, more flexible exit? Like how do you think about the exit strategy in those deals?
Yeah, I think you're going to use higher exit cap rates than you traditionally used in those markets. Don't forget, San Francisco specifically has pretty much the same transfer tax, the ULTA, as the ULTA transfer tax in LA. So you got to underwrite that in your residual. But otherwise, I think it's kind of a normal, whatever it is, a 5-year hold or 7-year hold in your modeling that you hope and believe that capital will come back to those markets as it ebbs and flows traditionally. But there are certain investors who have redlined those markets, and in the GFC, certain investors redline Las Vegas and Phoenix. We've seen redlining happen. Certain investors in 2023 redline Chicago, and you see those red lines, reverse. And so, you can't, like, just because something's redlined today doesn't mean 5 years from now, it'll be redlined. Usually capital comes back. Now, you can't control everything, and you have to do the best you can in underwriting in these times. But we believe these markets will have liquidity over long periods of time.
Yeah, I guess my point there is just for those listening. It's like when you think about contrarian investments, these markets, this isn't a fix and flip strategy for a 2-year hold, right? Like this is you need a little more patience. Right?
No, you have to be patient.
Yeah.
You can't assume in 2 years the capital floods back. You look at what happened in New York, and a lot of the issues are regulatory. New York, it was catastrophic what happened with regulation on rent controlled portfolios, and so that. But what I tell investors and others who get really concerned about this, in that case, you had investment managers buying portfolios of rent controlled apartments where the plan was once they got that vacant unit, they could pop it to market. And so there wasn't a cap rate in place that made any sense. It was really a cap rate on, if I could get possession of all those units, fix them up and rent them at a new market rate, this is what it would be. That's the cap rate they were buying at. So that ended up being a bad strategy because the rent control kind of stuck whether the unit was occupied or vacant.
Yeah.
No. That's the vacancy decontrol issue,
yes.
And so you just have to avoid that risk as best you can.
Yeah, certainly the New York rent stabilized market has been destabilized, at least from the investment standpoint. So you mentioned the regulatory risk in these markets. So I'm curious, when you go through underwriting, obviously I'm sure you're underwriting a lot of different things, but regulatory risk, it's not like there's a number, right? So how do you account or measure regulatory policy risk in an underwrite?
Yeah, well, I think, one is that's why you're getting like the cap rate premium. So you at least you are buying at a cap rate where you have positive positive leverage day one. So all else being equal, that rent roll, as long as it doesn't get materially worse, the regulation shouldn't impact it. So that you kind of have to look at where you are today and are you comfortable with that. I think we've always made money investing in regulated markets because as as an economist, the more regulation you have, the less supply you have. And that's San Francisco has, I think they're delivering 50 units this year. The city that size, you have, tiny corners in Nashville that deliver a lot more units than what the whole city is delivering. That's the regulatory environment doing its best work, eliminating supply, and you'll see that in these markets. It's scared the hell out of developers. So that should be good for your market rates. But I do think places like LA, you have to be prepared for. You could have moratoriums hit, natural disasters come, and it's just part of doing business there. So, it's there is no. It's a little more art than science in how you underwrite around regulation, but over long periods of time, you should generally do well. And we feel protected from the statewide protections that are offered under Casa-Hawkins and in the state of California. There are plenty of states with more regulatory risk. We saw, you might have been, delighted to own a property in Silver Spring, Maryland, and then in the dark of the night, they passed the most draconian rent control in the country in Prince George's County, Montgomery County, Maryland. So you kind of take that risk in all parts of the country that you wouldn't think exist. So you just have to, be very well versed in navigating regulations when investing in multifamily in general.
Yeah, you mentioned Montgomery County, but also, a place like St. Paul, Minnesota. Like, who would have thought right there, right?
Yeah, absolutely. Even Orange County, Orlando had proposed rent control. So
yeah, that got shut down. Yeah.
that got shot down, thankfully.
My favorite part of that story, I don't know if you remember this, David, you may have, is that they had hired a consultant to study rent control. The consultant says, don't do it. They pass it anyway. And then, of course, the state overrides it and doesn't allow it to happen, to preempts it. So just modern politics for us. So another question is, in these markets, you mentioned like the potential for eviction moratoria, whatnot. Does it change how you operate in these markets? Meaning, like, do you become more diligent about, tenant screening, things like that, just to make sure you're minimizing that risk?
Yeah, Los Angeles, we're so going through so much PTSD from the pandemic era regulations, but the collection levels are as good as they've ever been there now.
Oh, good. Yeah.
So, I think part of that is your credit screening, and part of it is the some of the new technology in credit screening, so I think all of that has improved. We've gone through kind of this era of fraud in our industry that has been a big problem, and again, technology has helped navigate around fraud, this kind of fraudulent IDs and pay stubs and other fraudulent information that is done in this industry. So we keep getting better in general as an industry, which I think helps us, as these markets, have future moratoriums that will have better residents and better quality credit behind the leases to navigate that better.
Yeah, absolutely. And one last question before I let you go. We talked about San Francisco, we talked about Seattle, LA, a lot of West Coast. We haven't talked about a little bit about New York City, rent stabilized. But you think about the city of New York and the city of Washington, D.C., these are two other markets that have become quite more challenging from a regulatory perspective. What do you think about those two? I don't believe you're there today, right? But what would it take to go there?
Well, so we're not in New York. We have been in New York, in Manhattan and in the boroughs, and I think it's one of the most desirable markets from a market rate standpoint in the country. I mean, the fundamentals are phenomenal. I have a son who lives in New York, so I can tell you how good the market fundamentals are there.
Yeah.
There's just so much demand and so little supply. So it's a target market of ours. I think the rent stabilized and rent controlled side of it is super tricky. So and I think if you follow this mayoral race going on, one of the leading candidates is running on a rent freeze platform. So New York, so if you're doing market rate, I think it's interesting. There's still obviously risks depending what happens at the state level, but it's a market that we look at, but probably the most sophisticated of markets to analyze from a regulatory standpoint and to understand.
Yeah.
I think DC, the district is what you're talking about specifically. Yes. Has rent control, has TOPA. There could be positives legislatively in the district, because I know there's a bill within the district for TOPA reform. TOPA is this tenant's right of first refusal to buy properties that make acquisition very tough there, because basically you go under a contract, the tenants have a right to buy it at your price, and it kind of can tie up the property indefinitely, and also creates a lot of bad behavior. Other people trying to support tenants to buy it and bypass the contract you may have, So just a challenging environment to buy just because of TOPA. But the other concern there is Doge, and what are the ultimate number of government employees that lose their jobs in the district, and then all the tangential jobs associated with that. So we're trying to get our arms around that. We haven't redlined it, but I'd say there's a yellow light on it till we understand better more about the job thing than anything. But it's always been a great market, and one we've been interested in. We're active in Northern Virginia, and I don't think we don't even have a yellow light on Northern Virginia. It's a market we like, but we are concerned about the district more because of the job losses from the government.
Well, David, I really appreciate you spending time with us today. This has been a lot of fun for me personally. I know that the viewers and listeners will appreciate it as well. So thank you so much for being part of the podcast today.
Yeah. Well, thank you, Jay, for having me, and look forward to seeing you soon. Thanks.
Yes, sir. And that's a wrap on episode number 40 of The Rent Roll. A big thanks to David for joining us today as our guest. Really enjoyed talking with him and getting a little bit of a history lesson and hearing also what he's working on today. Thank you to JPI and to Waymaker and Foxen for your sponsorships. And thank you to all of you for spending part of your day with us. We'll see you next time.